So for our next session, we're going to pivot from the consumer and corporate lens to examine the investor perspective. So to lead the conversation, I'd like to welcome Hugh Brown, who's head of BSR's financial services practice, where he advises institutional investors, corporations, and capital market participants on their sustainability investment strategy. We also want to thank Hugh and BSR for offering to pilot our private equity research with 5 companies. Welcome, Hugh.
Thank you for joining us. I know it's late in the day, and it's always hard after lunch. I know that Friday's fatigue starts to set in, and so I want to make sure we kind of set things off right. So with that, here we go. I am going to start with a dad joke. So at the least, yeah, you got this on video. So here we go, and hopefully all of you appreciate this in New York. So here we go. Why do seagulls fly over the sea? Drum roll, please. Because if they flew over the bay, they'd be bagels. Woo! I was nervous, but it kills at home, and the kids love it. I have a 7-year-old and a 9-year-old at home, and we're always searching for the best jokes, so we're in joke books and everything else. So thank you for that and that laughter. And for those of you online, I appreciate kind of rolling along with it. So with that, I'm Hugh Brown. I'm the global head of financial services at BSR. We are a 30-year-old sustainability consultancy working with companies and investors to implement sustainability at the enterprise level as well as at the portfolio level. We're located across North America, Europe, and Asia. In our session today, breaking through the barriers of sustainability value creation for investors, it's a relevant topic because it's proven that profit maximization and sustainability are not actually at odds with one another. Yet, it can sometimes be challenging to advance sustainability as an investor. So in today's session, we are going to discuss 3 key barriers, IRL, for those of you who are in the room. And so that continue to be a challenge for sustainability value creation. Of course, many of you know that IRL means in real life, but through the lens of our speakers here today, IRL is going to mean and means integration, results, and the life cycle of an investment. And even more importantly, we're going to talk about how to overcome them. So we'll reserve some time at the end, 15 minutes for some Q&A. So please hold your questions. Here we go. So I'm joined here today by Sanaz Raczynski, Managing Director of Sustainability at Kohlberg and Company, and Dr. Serge Younes, Principal and Head of Sustainability at Investindustrial. To kick us off, our panelists will briefly tell us about their firms and the work that they're leading at their respective companies. So Sanaz, let's start with you.
Sure. Hi, and thank you for having me. I'm Sanaz Raczynski. I head sustainability for Kohlberg and Company. Kohlberg is a 37-year-old private equity firm founded by the private equity industry pioneer Jerry Kohlberg, who had founded KKR. We are a mid-market U.S. buyout control-only investor. We've been operating in this space since 1987. And I joined in 2020, but Kohlberg's ESG program dates back to 2012. So happy to talk about that. In my role, if I were to summarize what I do in buckets, it would fall under 5. One is pre-acquisition work. We're a private equity firm. We're constantly looking at deals. So looking at, from a risk perspective, looking at pre-acquisition. And then the other bucket is post-acquisition. So now we have the company. How do we use ESG as a lever to create value? And then there is investor relations aspect of it. So I meet with our current investors. If we're fundraising, I meet with prospective investors. So depending on where we are in the fundraise cycle and where the limited partners are with their questionnaires, that part of my job ebbs and flows. And then I am pretty involved with industry development. Serge and I are both involved with the PRI and other working groups and industry initiatives. And then last but certainly not least is I lead also Kohlberg's foundation. So.
Very similar role on our day today, I think. Let me introduce myself before we get into comments. I'm Serge Younes. I head up the sustainability function at Investindustrial. You've heard our name a few times today. We've been sponsors and supporters of the Center for Sustainable Business for 8 years. Time flies. So I do get the privilege of spending a lot of time with Tanzi on some of the innovative stuff that you've been hearing this morning. Investindustrial was set up in '89 as a PE firm. It comes from an industrial conglomerate that's been around for over 100 years in Southern Europe, mostly Italy, Switzerland and Spain, but also in France. We've got about 15 billion AUM. Most of our investments are European, but we do have investments here in the US. And yeah, similarly, look, my role is very similar, except that we've started our program back in '07. It was led by our founder, Andrea Bonomi, who's an NYU alumni and trustee of NYU. And he's really been pushing this agenda for us. So I sit in a very cushy role, which is we have to execute a long-term vision. I often joke that sometimes he drags me into his office and goes on a 1-hour ramble and have no idea what he's talking about. But I learned when I joined 5 years ago that within a year or two, whatever he was rambling about, everybody's talking about. So kind of learned it the hard way, which is when he's rambling, write it down, go figure it out, and try to be the first that deals with it in the industry. So there we are.
Oh, that's hilarious. Thanks for that, Serge. So let's start with our first barrier, right? We're talking IRL, right? Our first barrier is integration. So many people here today are heads of sustainability or analysts or sustainability practitioners and even consultants, right? They're working day to day, day in and day out to advance sustainability at their respective organizations. But frankly, it's always not easy. So each company has their different departments with their different mandates. You've got risk, legal, compliance, investor relations, and many more. And while sustainability being maybe the number one priority on your list, it's often not the number one priority on their list until something goes wrong. So my first question here is, in today's fast-moving sustainability market, what does integration look like, should look like, and more importantly, how do you build the buy-in to be successful? So Sanaz, can you take that one?
It should be everyone's priority. But all jokes aside, maybe I'll start by saying what we mean by integration. So Kohlberg is not an impact fund. We do not have ESG branded products. So for us, it's the inclusion of these non-financial, environmental, social, governance factors that can have a financial impact on our investments. So because it's grounded in financial materiality and financial outperformance, the buy-in hasn't been hard. The buy-in is there. And I can get into some of the examples. But one of the things that I would say for anyone that is just getting started is that it's really important for ESG professionals to share the requests that you get across the organization. If you have a very large investor requiring, mandating that they speak to you before they co-invest in a company, make sure the whole investment team knows that. Because I'm often guilty of just running because we're also busy and not having a chance to make sure that the message is widely received that Walmart is asking your portfolio company will be dropped, or J&J is asking, your portfolio company is going to be dropped from the preferred vendor list if we don't do these things. So there's a lot of financial value there. And then the other thing I would say, lastly, as a buy-in, I think the reporting relationships are really important. At the end of the day, if ESG is sort of, or sustainability is sort of in the middle of the organization, it gets less attention, especially because it's growing so fast and there's some confusion around what it is. So if you have the head of the firm, I report to the CIO, backing what you're doing and being a supporter, I think that also helps with this buy-in if there isn't any.
Thank you for that. Serge?
Yeah, I mean, look, it's, I mentioned that our founder is very keen on this topic, but ultimately, I remember he told me the first day that I joined, he's like, I'm going to make you public enemy number one, because you're going to have to do that and everybody's going to hate you for doing that. Kind of fast forward about a year or two, I was told, well, hold on, people don't really understand why we're doing this. And there was a lot of kind of trying to get them to understand. Actually, we leverage our relationship with NYU quite a lot. So was it back in 2018, we had pretty much the whole firm sitting in a room like this. I can't remember which room we were in, upstairs, for a whole day and kind of complete immersion. And ever since, I think over 100 people between our firm investment teams, from managing partner all the way to analyst, but also CEOs, CFOs, and people that we hire for sustainability in the portfolio companies take the various courses, right? And so when you're having then that dialogue, it's a dialogue of they've heard Rosie, they hear it from us. Like Sanaz was saying, a lot of our portfolio is B2B. It's and industrial is in the name, right? So kind of they hear it from their customers, and then when they hear it from their investor as well, they act upon it. And then I ultimately say proof is in the pudding, right? So in the 6 years I've been around, we've seen finally some exits over the last 2 years of companies that we had bought when we started the program. And then, invariably you end up seeing that the companies that have taken the sustainability conversation on board, that have really transformed, that have, kind of pushed the agenda, are the ones where we've exited the best, right? Some who do it kind of okay are the ones where the returns are kind of okay. And then the ones that don't, right? So it's kind of, although it's a small sample, we're seeing a correlation. That correlation actually now filtered down into the whole investment committee, where people realize and now they question, why is it not happening at the portfolio company specifically? What are issues? What are the barriers? What can we do to unlock it?
So I want to continue with you, Serge, before we come back to Sanaz on another question. So it sounds like you're fairly lucky to work in an organization where it's extremely supported. But we know that support varies depending on the role and access to leaders within a company. And much of this work is rolled up to the top of a company. So what advice would you give to those here and those watching virtually who may feel like they don't have that proper support internally? Like what steps or a couple steps could they take to help build that some more internally as well?
Yeah, I mean, look, you can think about it in two ways, both at the firm, if you're an asset manager, but also in your portfolio and how you engage with portfolio leadership. Within the firm, Sanaz mentioned the various roles that we do, right? So strong relationship with the kind of investor relations team. A lot of European investors and asset owners are demanding it. Some of them are very difficult to deal with. And I mean, I had a meeting not that long ago where we had an investor, a pension fund, who sat me down and said, tell me company A, B, and C, where are they going to be in the next 50 years? I just sat there. It's like, I don't know, right? But then I sat in their shoe and I was like, well, you're okay, your pension funds, you're there. Money that goes in today needs to be released in 50, 60 years to people who are contributing their pensions or 401k, as you call it in the US. And they will be part of the various life of that asset. It might be in private hands today. It might be in your hands next, in a year. It might be publicly listed and in general public equities and securities. So they want to see what's happening, right? So there's a push there, and the investor relation community is starting to understand that. Then you're getting the investment teams, and they need to think way ahead. One of the main things that I say is my role in the firm, unlike the CFO that is looking on a quarterly and annual results, unlike head of strategy that is looking kind of the next 3 to 5 years, or investor relations that is looking at the next fund raising, our role is to look at what's happening in the next 15 to 20 years, right? So I say I'm the master of the crystal ball, right? I want to understand when we're looking at an investment, we're looking at something, where's the headwinds, where's the tailwinds that it may or may not affect us? Because if I buy something and it's going to be a dud in the next 5 to 7 years, then Sanaz is going to look at it and say that's rubbish. We're not buying it, right? So it needs to be still interesting for people. And once you get that conversation and get the people to understand that language, it flows easier. Whereas with portfolio companies, we buy businesses, lower mid-market and core mid-market in Europe, when you speak sustainability, they tell you, oh, we have a recycling bin. I kid you not. I was at a company a few weeks ago, and I was like waiting in reception. We had just bought them, and I could see the poor receptionist running with like A4 papers. She couldn't understand what the hell she was doing. And she was actually sticking a recycling logo on all the bins. So when I walked into the CEO's office, he was very proud to tell me that they have recycling bins, which clearly you could see that they've done it 5 minutes before, right? But you have to get them in a conversation that 5 years later, they are able to continuously bid to contracts with Walmart, with Nespresso, with other players, because they'll be out of existence if they don't take it seriously. And what we do is a carrot and stick. Right, so we come in with a plan. We have a 3 to 5 year plan at Investindustrial that all portfolio companies, regardless of who they are, what industry they are, they have to execute on. And then we do bespoke strategies done in-house. They're material strategies, sustainability strategies, but ultimately their sustainability strategies linked to their corporate strategy, right? And then what we turn around and we say to the C-suite is, so first layer, kind of the first C level, is 25% of your bonuses are linked to the execution of that plan. And then it escalates down. So if it's a S topic, it goes down to HR and then various other people and plant managers and all that. And then you turn around, and we've been using sustainability-linked loans for the last 2-3 years. So effectively what you're turning around is we're doing refinancing for debt, or we're doing a component of debt on the transaction. We're linking up to 10, sometimes 15 or 20 basis points, linked often to the same KPIs. So you turn around and you tell the CEO and CFO, you do this, you're getting your money. You don't do this, you're also losing out or paying more interest on the company, and you want to be in our camp. You want to please us as your majority shareholder.
So can I add to that?
Yeah,
I have a story
absolutely
about this. So the advice I would give is that if you're just getting started or you're not getting the attention, is to start small and iterate and share the case study. So the sustainability-linked loans are not that big in the US, especially in the mid-market. They're way more prevalent in the EU. But if I went to my boss, the CIO, and said, I'm going to get a sustainability-linked loan for all of our companies, he would have said, and there's the door. You can get out now. But what I did was I went to him with one recommendation. I said, this one company, I know the lender, they're like-minded, I know what they're trying to maximize. This company's KPIs perfectly align with what the lender is trying to. They have a credit facility coming up. And so we were able to execute on this one sustainability-linked loan recently. And I was good this time. I shared the story. I made sure that we wrote about it. We put it in our annual report. We shared it with all the portfolio company CEOs. And guess what? I got 6 calls that week saying, we have a refinancing event coming up. What can you do for us? So that would be my advice.
There's a lot of money on the table.
Yeah. Well, thank you. And I think my panelists know I have a confession to make for all of you here, is that, one, I am a Florida man. And I got to let you know. So it's really good to be in a room where you can say the E, the S, and the G words. And I'm happy to be here live from New York. So Sanaz mentioned you're not an impact fund. So does the politically charged environment make it easier or more difficult for you to navigate and build a buy-in and move forward now?
So as I said, ESG for us is just one other data point. We're not excluding sectors. We're not constraining portfolios. We're not taking a stance on policy or ideology, and we're not new to it. So we've been doing it for a decade. Our investors know what our intention is. It's fully grounded in financial materiality and financial performance. Now that says, so it hasn't really had an impact on Kohlberg. Now, personally, this is not a Kohlberg statement. Personally, I think I would be lying as an ESG professional if I sat here and said, no impact. I think it does have an impact. We read the news. So many of the large asset managers are changing names to, from climate to like transition. And while that might seem like a small change, I'm sure they spend hours working. I've worked at a big company. Those things take hours of work to get through. And I find myself, nobody told me to do this, but I find myself reading and rereading and rewording everything that I write these days. And that's, this is about barriers. The biggest barrier I have is my time. I don't have enough time to spend with my portfolio companies, and yet I've wasted 5 hours this week because our annual report is coming out, wordsmithing. So that would be my statement, not the company's.
Can I pitch in here?
Disclosure there, just for you all. Sure,
Can I
jump
pitch in on that?
Yeah.
I actually want to say, thank God that they raised that issue. Don't boo me. Don't throw tomatoes, okay? Because it actually helped us focus on value creation. We're not, yes, the outcome is we're saving the world, we're doing all those good things, and there's a big focus on society. But actually, how many panels have we sat on over the years, right? And we're talking, and we're doing this, and I'm telling you stories, and you guys are laughing. But how can you manage a business with financial anecdotes when I'm telling you sustainability anecdotes? Right? The focus has to be on how do you bring it back to what is material, what is important, what is going to drive the business. And actually, that conversation with the red states just pushed us down that route. We're talking about where is the impact, where is the 10 things, 15 things that I'm doing with each company that's going to drive better profitability, that's going to make that business kind of future-proof, that's going to drive revenues, and ultimately bring value back to them.
So Serge is helping us pivot already to barrier number 2, results. And so measuring value creation. So, right, we know that there is some sort of impact. It's hard to prove. At the end of the day, operating a business in a sustainable way is important for many reasons, right? It supports the company's reputation, aligns regulatory processes, instills a solid risk management. I'll double underline risk management there. And over time drives alpha, right? Everything that we're always looking for in the investment space. But given you have to produce these sizable risk-adjusted returns for your investors, you must show that sustainability can also be good for the day-to-day business. So Serge, starting with you first, what are some of those ways that you can illustrate sustainability positively hitting the bottom line?
Rosie, baby.
Right there.
Big supporter here. Look, ultimately, when you're doing due diligence, I mean, historically, we've always been looking at risk, right? So my biggest focus had always been, where's the 50, 100 million that can remove from the deal because there's too many liabilities. And for many years, we've been forgetting the commercial opportunity. I mean, I spent the bulk of my career in strategy consulting. So, when I get commercial due diligence, I get frustrated. I'm sure some of you have heard me say that before, is why is it on page 600 that somebody says, you could do X, Y, Z, and it's green, and it's nice, and it's colored with some leaves on it, when you turn around and say it's core business, right? There was a great example that was mentioned this morning around, the kind of more natural, sustainable, et cetera, products.
Yep.
We had a deal, pharma retail, and it had 2 comments on page 400 and 600. One was, for all the competitors, they're offering green supply chain. So you tick the box and you're getting green delivery with like a DHL or somebody. And then another one that was some random comment that says, you can B Corp products or nature or chemical-free products selling 20% at a premium, right? Which is kind of the right number. So I had a call with the partner at the strategy house and said, on page 2, why isn't that into the EBITDA bridge and the revenue bridge? It's like, did you forget that? It's 10 million packages a year. Just assume it's 1% that we're selling that is some of that kind of premium products. Duh, right? Why are you telling me that the market in Europe is growing by 1-2% CAGR when I want to know what's growing at 20% CAGR? That's the one that's interesting me. So actually, for us, is starting to get that bridge into where is it growing and growing through sustainability, and where can you pivot? And then ultimately, I mentioned Rosie is when you're working through that process. I mean, Rosie is phenomenal because it's very detailed, it's very bottom up. But where we tend to use it is towards the end of our holding period to kind of prove, right? And then actually the project that you saw earlier, was it last year at the end of this forum, Tanzi, that we were talking about this? It's like, Tanzi, surely with all the knowledge that we've created here at NYU, working with all of you in the room, building Rosie, we can drive a hypothesis-driven tool that we can use, where we're looking at pharma, we're looking at whatever is the industry, where are the top 5, 10 things that will have an impact that then we can model and turn back to the deal team and say, we need to do those 5 things, and that's how it's going to change the valuation for that business.
Thanks. Sanaz, you want to jump in on that?
Yeah, so when I think of value creation, I think of 4 levers. So one is revenue. We're looking to grow customers, expand products, and because we're mid-market, all of our companies are B2B, and they are selling to larger, often public companies that have sustainability commitments that they need to push through in their value chain because they can't go net zero without their scope 3. So, you know, I think I was telling you this, that sometimes I have to get creative with risks and the way I frame things. So for revenue growth or revenue retention, one of our portfolio companies is a consulting firm, but it serves the pharma sector. So all of the customers have very specific and public sustainability goals for scope 3. And so they were asking for the Science-Based Target Initiative submission. And the company, my point of contact at the company, was getting pushback from the management team. So what we did was we went through every RFP that had this SBTI request. And then we looked to see how much revenue the company generated from these companies. And then I made it up. I called it revenue at risk. And it really caught the attention. And we've submitted to SBTI, and we're doing well. So that's the revenue side is one. We were told by at least 2 of these big customers that the company would be dropped from the preferred vendor list. So you say that to the CEO and you show how much revenue we got from just those 2, things get moving. And then the second part is operational efficiency. I think on the cost side, on the E side, that's a little easier. You lower carbon footprint. It's because you lowered energy or fuel usage, and that is cost savings. Like we simply put in zero idling policy for one of our companies that distributes a lot of things. And it was mind-boggling to see how many of the drivers would just drive to deliver things and leave the cars on for hours. We had one driver that was leaving the car on for 30 hours a week. And then that you can immediately translate into dollars. And then the next thing is this cost of capital that with SLLs, which again, they're not as big in the US, but hopefully they'll go back to growing. And then finally, it's the exit opportunities. The hope with all of this is that we can get, an impact at exit.
Can I just add, Hugh? I mean, it's something that I've actually heard Tanzi say before, is the bulk of the CFOs don't actually think about the avoided cost or potential revenue at risk. The number of portfolio companies where, including, a company that serves Nespresso, if they hadn't done what they had done in terms of science-based targets and getting EcoVadis ratings and so on, they would have been dropped out. And, they manufacture a critical component to their coffee machines, right? So we've seen that actually, it came from a consumer goods. It blew my mind last week when I saw that. I was with one of our portfolio companies, and they showed me a tender from one of the big consumer good companies, and it was that final tender price is based on the price multiplied by the inverse of their EcoVadis rating.
Oh.
I fell off the floor. And then looking at the competitors, we're the only ones that have an EcoVadis Platinum, whereas the others have silvers and bronze, or not even an EcoVadis rating, right? So then you're like, all right, get your attention.
Well, I know we're coming up on time for Q&A, and we're going to hit our last barrier, which is the life cycle. So the investment cycle is a very standard process for institutional investors. In short, is identifying an investment, due diligence, management of the investment, and finally, exit of said investment, right? In the last few years, we've seen private equity allocations have continued to rise among asset owners to diversify the traditional risk of equity, as well as take some profits off the table. But beyond the typical PE time horizon of 5 to 7 years, the alternative investment bucket continues to grow. And as the world transitions to a net zero economy, this creates more opportunities for PE and investors to even take on a longer time horizon, right? Infrastructure and those things as well. So I'm curious from the both of you, where do you see the opportunity in longer held assets and or risks? And how do you communicate that through your holdings? Now, Sanaz, let's start with you. Yeah,
so in a previous role, I worked in agriculture. And I will say that, and that's how I met Tanzi, most real assets, the fund life cycle is around 20 years. So if you're in agriculture and you're holding the asset for 20 years, you see the impact of climate. It's not some abstract thing. You're seeing it year after year. If you're growing wine grapes in Napa, California, wildfire has impacted you for the past 5 years. And it will continue to do that. So it's a real thing, and there's no need to go convince anyone. And I missed the agriculture panel earlier. But in private equity, the way I communicate to the investment team is that while we're going to hold this company on average for 5 years, whoever we sell it to, which is often another financial sponsor, is going to hold it for 5 years. And their expectation is that their buyer is going to hold it for 5 years. So they're going to think of their exit, like we always think of our exit. Mm-hmm. So for us, the time period is hold times 3. So I'm always looking at a 15-year time horizon, which things start looking a lot more real when you're looking at 15 years. If you are thinking of the impact, if you're serving the car industry, you better think about what EV market is going to look like. In 15 years makes that. You don't want to end up with a stranded asset.
Serge?
Like very similar, right? So it's kind of ultimately what I say, it may not be our job to move the needle completely at each portfolio company, but we need to just push it in one direction. If there's any sailors or pilots in this room, you know, 1 degree now means 100 miles after 5 minutes, right? So it's kind of, you're working through that trajectory, and private equity is the same. You know, we're holding now, move that needle by a couple of degrees, and then you'll see the effect in 10, 15 years, right? And then, what we say, we've had assets that have come back to us. We sold businesses 15 years ago that we rebought in the last 2 years, right? They're under different name, under different guys. I've seen certain factories twice, 3 times now, right? So it's still here, and you actually need to push that needle. I think the other point, which is a problem for us when we're looking at that 15+ year horizon, is what used to be remote events are becoming more regular events, right? So I'm going to give you 2 examples. We have a tomato business in Naples, in Italy. They do some Marzano, beautiful tomatoes. You find them in big major retailers, either as B2B, but also own brand. And when we came into the business 2-3 years ago, we're like, that's going to be a 10-year problem. Let's figure out how we're going to deal with droughts and tomato crops and so on. Well, we've had 2 years of tomato crop failures in Naples, right? This year, July was 45 Celsius, that's 120 Fahrenheit or something like that. And then come beginning of August, we had hail the size of, big tennis balls. So crop was dead. And that shocked us. And then, we have factories around Germany and Belgium, for example. And we had 3 years. We had 2 100-year storms and 1 1,000-year storm. In 3 years, like, that's not 1 in 100 years. That's every year storm,
exactly.
Right? But actually, that's causing a problem because insurance companies don't want to insure us anymore, right? So then you have a stranded asset, and turnaround's like, well, that was insured, but the cost of the building and the inventory and the machinery in there are, say, 40, 50 million. I just wiped out the investment, right? So you kind of have to push yourself to think about those things really hard.
Yeah, it really does force us to think differently, especially when we were looking at those models. And I like to say a lot, all models are wrong, but some are useful. And obviously in the terminology of 1 in 100-year storms, we're seeing these things every other year. Obviously that was wrong, but I don't even know how useful that information is now. So with that, I want to thank our speakers. I want to make sure we open it up to some questions from the audience. I see one over here. Then gentleman in the back after in a green sporty vest.
Number one, thank you all for coming and talking to us today. My name's Andrew Jolly. I'm about to graduate from my MBA. And I was just curious, Serge, you mentioned, CFOs don't think of those avoided costs. It occurs to me that in these mid-market firms, you're having to put in all the work to model out the impact of implementing sustainable changes to how they operate. And that just doesn't seem to work for the many hundreds of thousands of mid-market firms that exist. So how do you go about trying to accelerate that education within your portfolio companies to make that, simpler job for you long term?
There's education. I mentioned all the work that we do with NYU in terms of educating those folks. But ultimately, you should speak to Jennifer, my number 2, who's sitting next to you.
Another plug right there.
We were earlier this week. We're in a company that we have in Dallas, and a year ago, literally this week, a year ago, we had just bought them. Just came and had a conversation with them. And we're having the whole sustainability conversation. They're in the food business, so they kind of got it, right? But they're like, as a CFO said, or a CEO said to us 2 days ago, it's like their business is sugar and butter and oil, right? Okay. But Jennifer actually asked the CFO that question, is like, what's your turnover rate? It was over 100%. And she asked him, and how much is that costing you? And he didn't have an answer. Right, so they went in, and today we're talking 2 days ago with them about where we are with that and what's the program and what's the plan. Just focus on what's really material for each business. Of course, we can do 100 things, but who has time to do 100 things, right? People have time to do the most critical 10 things, and there's 100 other critical things that are running in the business. And so you're trying to bring in the sustainability component by making it relevant to core business issues, right? And I guess that's kind of what's missing in education at the moment, is linking planet to numbers, dollar signs on the P&L, linking social issues to the P&L. I mean, look, sometimes you have to take a very difficult view. I know I'm on the record, so bear with me. We have a business in Italy. It's a very small factory. It employs 60 women, and it runs for 5 months a year. And they do marron glacé, chestnut with sugar, okay? And we're like, what's the point of that factory? It's losing money. So if you're looking at it from a P&L perspective and you're a ruthless banker like most PE folks are, like, get rid of it, right? But then actually when you realize that is actually the last artisanal marron glacé producer in Italy. And there's 2 other more in France. If that's gone, that's gone. So of course we weren't gonna get rid of it, right? And then we thought about it, hold on, that's also 60 women, and they're mothers of families, and that's their only income throughout the whole year. Why would we? And actually the whole conversation then changed into, can this become a premium product, right? Can we sell that marron glacé as the only handmade, hand-picked, hand-produced marron glacé in Italy? And it works.
We have one over here.
Thanks. We had a gentleman in the back.
But we have a mic here.
Oh, mic here, and someone bring the gentleman in the back a mic after.
Yeah, so I think you had indicated that you had 2 companies that you had exits that you can correlate maybe their ESG performance. Can you talk a little bit more about how you calculated that correlation, and any advice for companies in terms of how we can maybe model that ourselves, I guess, in the future?
Yeah, I mean, look, there's the tools, there's the work from Rosie that you can build up, and it's bottom up, and you can get to what's the impact on revenue and what's the impact on profitability, and that's kind of the role that you and I do and others do in the industry day to day to try to prove what we've done, what we've impacted. The difficult part is then to the conversation on enterprise value and multipliers, right? This is the real uplift in our industry, whether it's VC all the way to private equity, anybody in private markets. And you have to change the discourse in the company. So one of those examples, one of our best exits in recent years, well, there's actually quite a few that I can talk about, but conscious of time. That particular business that I like to talk about is a business that does large format ceramics. They look like marble, they feel like marble, but they're not marble. They're big slab ceramics. And when we came into the business, it was a family business, and we bought it at kind of multiples that are equivalent to building materials. So whether you're buying cement or steel or ceramics, that's the multiple. And the rationale for that is they actually didn't realize what was the intrinsic value that they had here from a sustainability story. They were selling it to contractors who are looking for ceramics. So it's them against everybody else that did tiles. We changed the discourse because we realized as we were working with them is, well, first of all, compared to real marble, you're not cutting a whole mountain off, right? So there's a first impact there. Second impact is we did 2 projects. One, which is in Europe, we have a regulation that is trying to remove silica because silica, especially with workers cutting marble, etc., they get cancer, right? So the whole industry is moving to zero silicon. When we looked at the 3 competitors that we had, we were the only ones that could get to zero, and that was the product that we released. So 0% silica in that ceramic. And then the third conversation that we had with them is, how can you change the conversation with your buyers and change who your buyers are? So we went out and we got all their products LEED certified. So if you're doing a new commercial building and you want to be a sustainable building and you're looking for a ceramic that will give you the points, that's the only company that can do it today, right? And then I said, don't speak with contractors, go and speak with interior designers and architects who are very sensitive to the sustainability topic. So guess what happened when we got to exit? Not only was it a great business and we did all the operational excellence and everything else, we got into multiples not of building materials, but of design. And this is where we made the money. And that's how you need to calculate.
Thank you. We still have the gentleman in the back. There, no. Oh.
Thank you. Do you want to
No.
give an example? Measuring value creation.
First of all, thank you for a great presentation. Right here, Serge. But asking from both a US and EU perspective, how have you both seen regulation, both for investors and corporates, affect those conversations with portfolio companies, in terms of how to adopt sustainability practices? Has it been value driver? Has it been a hindrance in terms of focusing on things that may not be overly material?
Yep. Take that one, Sanaz.
Thank you. Yeah, so I was so excited when California passed the climate ruling, because so many of our companies, instead of panicking, knew they were ready. And it was sort of a proof that what we've been doing is not to just satisfy, or what they've been doing, which they may have thought was not material to their business, all the carbon accounting that we've been working on, all the decarbonization work that we've been doing. It was immediately now, well, you're required to do this by law. And by the way, California is, I don't know, 5th or 6th largest economy in the world. Every single one of our companies deals with California. So even if you don't meet the revenue thresholds, you have customers that do. So you fall under their value chain. So I think it really reinforced that what we were doing was value creative, and it was preparing them for what is surely to come from a regulatory perspective.
I hate regulation. But I see that it's very useful, right? So Europe brought in the CSRD. It's an absolute mess. You're going back and forth. And actually, the opportunity cost of wasting a year and a half in preparing for it versus doing the real work is utterly frustrating. I guess once we get there, it's great, because suddenly you have 50, 60,000 companies around Europe that will be producing very high quality data, and then you can manage better using data. I want to be a bit pragmatic here. I actually want to reference our keynote speaker this morning in saying, my gut feeling is we're innovating, we're moving too fast. And we're seeing it in Europe with people getting left out. And I often complain to the EU, and I've had many conversations as part of our industry stakeholder engagement that we do as an industry of, you've gone too fast. You haven't taken sometimes due care in understanding social impacts. What are you going to do with, I'll give you an example. I have an electric car and it broke down. And the company that manufactures it, Mercedes, said there's only 4 places in the whole of the UK that can repair it, and the next appointment is in 2 months. So I've been driving a car that has no heating for 2 months with 2 little kids, right? And so the question was, well, why haven't you trained your workforce? Oh, well, we haven't thought about it, I think there was a gentleman earlier who went to Paris and was excited about Paris being a cycling city. Well, have you thought about the 35,000 people in France that have lost their jobs because they work in the repairing and selling and doing all that for cars and for motorbikes? France hasn't trained them, hasn't given them an opportunity to transfer. So people get frustrated about what's going on in the US and the anti-ESG, and I say, if we're not careful, it's coming in Europe. But the bright side from it is, this room, we have the opportunity to be mindful about the pace of that change, because we know the change needs to happen. But just my parting comment is, be mindful.
With that, I think we're closing, and thank you all for having us, and we really appreciate it.